So the Bank of England have announced that for March 2024, the base rate of interest is going to remain where it is, 5.25%. We've been at this level since August of last year. That was the last time we saw a hike to the base rate, bringing us to that level, 5.25%, which is the highest that it's been in 16 years, since April 2008. So no change at all again. So what does that mean for us in terms of our savings, our mortgages, our other borrowing? What does that mean in terms of the likelihood of a cut happening at any point in the coming months? Because you might remember, just at the start of the year, there was maybe expectation that we might have seen the first cuts happening at this very time. Obviously, that didn't happen. So what I'll do, first of all, I'll take you through what the minutes say for the Bank of England about this particular decision, and then we'll talk about savings and mortgages and anything you might want to be doing right now. So why did the Bank of England stick at 5.25% rather than make the first cut, which has been, again, sort of hyped up since late last year that will be happening at some point? Well, there has been some movement in terms of the 9 members of the Bank of England in terms of what might be going on. Last time round, at the start of February, of the 9 members, 2 people still wanted an increase. Now, that was less than the time before that when 3 people wanted an increase, but 2 people did want a hike still. They have gone. No one voted this time for a hike. So that's good. That sort of shows movement away from, for some people at least, thinking we still need to do more, which again lends even more to this kind of theory, this thought that really we have peaked on those rates. They are not going to go up, which again, I think everyone's been thinking about for a while, particularly when we're talking about cuts to come. But you never do know, with some people still angling for it, at least anything can happen. But that's looking quite good. Now, the rest of the people, this time, so last time there were 6 people who wanted it to stay where they are. Obviously now those 2 people who wanted hikes have joined them. 8 people wanting to kind of, let's still keep an eye on where rates are going. So no one extra sort of angling for a cut. And you've still got the same as 6 weeks ago in this meeting as well. One person saying, I think we should reduce the rate right now. So again, movement towards, away from hikes, towards cuts, but still not too many people sort of saying, yes, we need to do it right now. And the reason for that is, the reason why so many of them are saying, look, let's stick where they are, is because they still don't know if all these hikes have done enough. Now, done enough to do what? Well, the whole point of the base rate increases is to try and bring down inflation. And inflation has been coming down. You know, in autumn last year, we were looking at, well, no, more than that, we were looking at sort of double digits, weren't we? Now we are down, announced this week as well, inflation at 3.4%. And the Bank of England still expects some point in the summer to get to that 2% target. This is an important thing for the Bank of England. 2% is seen as a healthy level of inflation. You don't want no prices to increase at all, because then there's sort of stagnation. You don't really want deflation when prices drop down. You want a healthy, smaller level, and they say 2% is what you want. Things are going towards that. Coming down 3.4%, which is the lowest we've seen for a long time, the fastest drop in one sort of month to month, and it's been for a long time. So those sort of things are all looking good, but they're still not sure that enough has been done. And that's because, just remember, a month ago, inflation stayed where it was. You know, it stayed at 4% for 2 months in a row, where they thought it would drop down. It didn't. And though this month, that 3.4% is slightly lower than what was expected, which is good news. Again, there's still certain other measures of inflation, if you like, which are still a bit higher. So core inflation, that's another measure. That one is still around 4.5%, something like that. And then you've got services inflation, and that's around sort of 6% as well. So they're still quite high, those ones. The Bank of England is still keeping an eye on those, still wanting to make sure that inflation does drop down and keep coming down. Now, this kind of sense that it's going to go down to around 2%, that doesn't seem to have changed around the sort of the summertime. And if this does continue in the next few months, the next time the Bank of England does meet, well, maybe not then, maybe the one after that, then you might potentially see that first cut coming along. I've sort of looked through all the sort of analysis and commentary from different people talking about this, and June or August is when that kind of expectation right now is from the markets for the first cut, bringing us down to 5%. Now, again, just a few months ago, we were saying it could be March, could be April. Now we're saying June, probably August. You never know with these things, right? Could be earlier, could be later, might not happen at all. But that's something we focus on. And still, the markets are still thinking, same as 6 weeks ago, that we'll now see 3 cuts to the base rate in 2024, meaning by the end of the year, we're around a 4.5% rate. That's the current predictions. It's important to know what the current predictions are, because that is what the lenders and the banks with savings accounts, what they kind of inform the rates they give you. It doesn't matter if things change in a month's time or 2 months' time or 3 months' time, then they'll change what their thinking is. But at the moment, they're basing it on what the current thinking is. So let's talk first of all about savings. They have been expecting these cuts for a while, and that's why we have seen a number of those fixed rates really sort of be dropping down since their peak of last summer. And I've been saying to you guys for a while now, they have peaked. If you do want to fix and lock in, really it's better to get a rate now, because they're unlikely to sort of go up significantly. Now, saying that, we have seen, and I think this is partly because that first cut to the base rate has been delayed slightly, we have seen a little bit of resurgence in some of the 1 year fixes. So 6 weeks ago when I did this update for you, the top 1 year fix was 5.17. Right now, when I'm recording this, it's 5.26. In fact, just a few days ago at the weekend, there was 5.28%. So there has been a little bit of a surge on 1 year fixes. There's a little bit of kind of movement around, but tiny amounts on some of the others. And yes, some of that might be because this first cut in this year has been potentially slightly delayed. But also, you're always going to have a little bit of kind of competition. Different brands want us to be top of the tables and sort of say, well, I'll put my rate up a little bit so I'm at the top and get the money in, and someone else go, well, to be at the top above that one, you've got to go up a little bit. But I think it's like a temporary little blip, but a good sign that, if you do want to fix and you can lock in, then it is well worth doing it now, because all the signs are saying that we will be seeing those cuts this year. And although, again, much of that has already been priced in, it doesn't mean they're going to go up. It means all that's going to happen is, if they probably go down further or more, banks will sort of reduce their rates as well. Now, one thing where it is important to actually do talk about this, though, is easy access rates. They are also, although the rate hasn't changed, you think, well, the rate hasn't changed, the base rate hasn't changed, then easy access rates shouldn't change. Well, they have been. A number of different providers have pulled products, or they've reduced their rate, or they've announced that they will reduce their rate. The big one here is Santander's very, very popular 5.2% paying account, which launched last autumn. Loads of people signed up for it. It was a really good rate at the time, well above the rest, although others later caught up with it. They've announced that from May, that rate is going to drop down. So if you've got money there, you'll know it will fall. Other providers, Chase, for example, they've announced that their interest rate is going to follow the base rate now. It will always be a certain amount, 1.15% below the base rate. So we now know if in a couple of months' time the base rate does drop to 5%, then CHIP's rate will drop from the current rate of 4.1% to 3.85%, and that follows CHIP and Tandem doing that. So Chase are now joining CHIP and Tandem with that, and a few others have got this. So easy access rates are going to be falling. Even if they haven't gone now, or haven't been announced to go, they are going to drop. So just a word of warning there, that any variable rate account you've got, it might look great right now, and it is great, but compared to a fix, if you can lock away, those fixes will mean consistently you get more for your money over a longer time. The flip side is, if you want to access the money, you won't be able to. So I don't anticipate there to be any kind of major new accounts coming on with particularly high rates. There are always going to be exceptions. And obviously, we are in ISA season right now. The end of this year, the start of the new financial year, there will be competition from providers wanting to get your money. Sometimes that will be higher rates. Sometimes that might be bonuses that they offer. So do obviously keep an eye on those ones. Again, it's going to be, I think, it's relatively marginal where we are, not actually massive jump ups or massive cuts over the next sort of month or so. In terms of mortgages, obviously staying where it is going to be disappointing. Yes, it's better than them going up, but disappointing that we didn't see a cut, because again, so many of the mortgage providers have been pricing in rate cuts to come, which means they've already reduced many of those rates. It doesn't mean there's not going to be any movement down. When the inflation announcement happened on Wednesday, NatWest cut their rates on some of their mortgage deals. I'm sure other providers will do the same thing, but these aren't drastic, massive reductions. We really need a cut to actually happen, I think, for those rates to come down, because then they're anticipating the next cut after that and the next cut after that. Because again, these are with mortgages, you're not really getting a mortgage on a short-term deal. You're looking at 2 years, 5 years, potentially even 10-year deals, and that's where they're looking ahead on what could happen there, and that's how they're sort of choosing the different rates available to you. Now, obviously, if you are someone who's on a variable rate mortgage or a tracker rate mortgage, you probably won't see any change anyway, because there's been no change. And if you want to fix, you definitely won't see a change because you're locked in. But it doesn't mean that when your fix finishes, or if you're a first-time buyer and you're looking to get your first mortgage, but you won't suddenly be faced with rates much, much, much higher now than when you first had your mortgage, or if you had got your first mortgage a few years ago. So with that in mind, it's worth talking to a mortgage advisor or a mortgage broker and getting their sense, I would say at least 6 months before your mortgage deal expires, of what's available, and ensuring that when you do get one of these deals, it's with someone where the closer you get to the actually need to activate the mortgage, if a better deal's come along, you can swap that rate down, you can change it down without any penalties or any fees. So to have a conversation, the earlier, the better. You could get something now, which looks really good, and it might be the best rate in 6 months' time. But again, if things change and you can get a better deal, then that feels like a great thing to be doing. So the Bank of England will be meeting next in 6 weeks. I'll do another update for you then on what they say and in what that might mean, again, for your money. My name's Andy Webb. Thank you so much for watching. Check out these videos here for more ways to make the most from your savings.